please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
This is Bazaar Morning Call, live from the CNBC TV18 headquarters in Mumbai.
Minutes and power at the India Business Leader Awards. Good morning and welcome to Bazaar Morning Call. I'm Lata and with me are Anuj and Surabhi. Well, it's my sense is next year is going to be a much grander India Business Leader Award because India Inc. is on its front foot now. We've seen 3 or 4 years of this backtracking, but my sense is 365 days from today, we are going to have most of the banking woes behind us. We are going to have perhaps more and more growth ticking up. I look forward to the 14th India Business Leader Awards. Well, just to strike a more near-term note, my sense is also this trade, war cries, not war at all, is actually going to bypass us. And I mean, the tweets that have come lately from President Trump also indicate that he's only making this noise to get Xi Jinping to the negotiation table. My personal sense is that this morning we are starting with positive cues for India, positive cues coming from the banking sector with respect to bond limits and perhaps even some NPA tweaks. So I'm at the moment, despite that very poor jobs number from the US, my sense is India is on the front foot at this point in time. It may just be a hunch, but that's the feeling. Morning, both of you.
Good morning, Lata. Good morning, Anuj. You're right. I mean, I don't know. Born with the best, 007. What is going on in that market? The way things have turned around. We'll come back to that. There are fresh announcements with respect to those FPI limits. But before that, equities. Anuj, now your thoughts. The point that Lata made, it's getting so interesting that these days the Dow can do 500 points, 600 points, and it simply doesn't matter. We saw that towards the end of last week. And if Asia has anything to go by this morning, then again, Asian markets are really taking it in their stride. So where does it leave us?
Morning, Surabhi. I think maybe, it would be a bit of a stretch to say it does not matter. It matters. But obviously, we are all students of economics, right? There's this diminishing marginal utility concept. You give a boy a mango and he'll like it. The second mango also he'll like it. Slowly, that taste of the mango, I mean, it won't give you that much utility. SGX Nifty is showing you downtick of about 45 points. For starters, I don't think we should have that weak a start. I think there's a high probability that we have a near-term bottom in place. Again, it could be violated in May. We may again go back below 10,000 in May, and in the April we may have a rally which looks like it's the real thing. The bull market is back. Essentially, we first had a price correction. Now we have had a time correction. The time correction has allowed the moving averages to converge. If you see the 20 DMA and 200 DMA, both are now at 10,200. So I think if you are a risk-reward trader, right now you have a very sacrosanct stop at around 10,200, and if you have a gap down, in that case, my sense is traders would try a long trade with 10,200 as a stop loss because the band is now 10,200 to 10,500. For today, of course, Friday's low of 10,290 would be the first reference point. The SGX Nifty is indicating that perhaps we start there, though I don't think we should start 50 point lower because Asian markets are quite okay. So, and ICICI Bank has shown signs of bottoming out. Bank Nifty has shown signs of regaining its mojo. The problem with the Bank Nifty is it's now right at the 200-day moving average and is sitting on a big rally of about 700, 800 points. So, a big move on Bank Nifty is possible. Will be interesting to see if it's on the upside or downside. The way to play today, I think, is to just let the first hour weakness, if any, to go by and then see if that is being protected. If that first hour low is being protected, mid caps will have a big rally because you saw it on Friday as well. If the market get a sense that a low is made, in that case, mid caps normally do well. So for me, today's trade would be something similar to Friday. Just observe the first hour low, see if that is being respected. If that is the case, I think there are enough stocks. We'll talk about them. So many stocks in the broader market, especially in NBFCs at new highs. So that, I think, would be the space to focus on.
Oh, yes, absolutely. You will be hearing from some of the biggest marquee names in the NBFC universe over the course of the next 2.5 hours. But Lata, just a word on the additional announcement that's coming. And it seems as sort of one piece of good news after the other for the bond markets, right? So the FPI debt limits now, to what extent does this help the cause of the bond traders?
What you said earlier was more important. One good news after another. It's not 59,000 crores that's important because the market was actually expecting that the FPI limit could even go up to 7%. What we've got is 6%. next year. This year it's 5.5%. So, you know, it's more or less in the price. But the point is, one good news after another. The government and the RBI are worried probably about bond yield levels, and therefore one thing after another. And that's what will keep the, momentum up. And the other point which actually Ritu Singh, my colleague, broke on Power Breakfast, she says that there's a very strong feeling in government circles, and she was at IBLA talking to all the government guys, very strong feeling in government circles and banking circles that some tweaks to that February 12th rules may come. I mean, obviously this is in the realm of May, but a strong expectation from the government is not something she thought should be ignored. So, and again, as Anuj pointed out on ICICI Bank itself, there is a lot of negative noise, but none of them are earnings moving. We must remember that it is not speaking about any loss to ICICI's earnings in the coming quarter or the next quarter. Sure. It's a lot of negative noise, and we don't know how things may pan out from here on. But my point is, there is a good reason why ICICI Bank is showing that support. It's because these are not earnings moving negative news. Yeah. And if, of course, the bond news and the NPA news comes, it's actually PSU Bank positive. Not, of course, Axis and ICICI will benefit from the NPA rules, but it's more PSU Bank. So again, that dovetails, Anuj, what you're saying about mid-caps. These are not bank nifty heavies, you know, the PSU Bank. So more than the nifty bank, it's the mid-caps that might be.
And I guess, Anuj, the point you made on NBFCs, I mean, just about, what, month and a half back, we were staring at levels of 7.6%, 7.7% on the yield. Suddenly, the market is talking 7%.
Absolutely.
So the NBFC party perhaps is something it's only logical to draw the conclusion, right?
You know, the NBFC rally got punctured after that PSU Bank recap, because the thought was that they'll come back and
take the market now. Yeah.
And this whole PNB issue has just told you that, that was just wishful
The
thinking.
NPA issue has completely paralyzed PSU banks.
Okay, on that note, let's kickstart this morning's Bazaar. Take a look at the calls that we're getting from the wise experts as we get into trade today. Mahesh Nandulkar of CLSA believes that Indian macros have turned adverse on multiple fronts over the last 3 to 4 months, with the sole exception of domestic flows into equities, which too has shown signs of weakening in the month of March. The data for domestic equity mutual funds inflows shows a sharp 44% month-on-month deceleration in monthly flows and appears worrisome. CLSA, however, believes that the last month of the financial year always brings some volatility in the data, which makes it difficult to draw a firm conclusion, and that the April-May data would provide a clearer picture. But risks appear to be on the downside. Mahesh believes continued domestic flows support of $2 to $2.5 billion a month is required to support the large equity paper supply expected in the current financial year, especially as FPI flows appear to be weak. Well, if anything...
Actually, that's important. Anuj, I wanted to point on that. You know, we already have negative FPI flows, and this March number is a bit of a heart attack.
You know, I would completely ignore the March number because, you know, March was a month where we spoke about it, Lata. You would want to take money home because, you know, you can always buy back in April. The issue here is that, you know, you made so much money in the market, and you know, in the March redemptions, it's not necessary that you know, you would have bought in October, November, December, or before that. You would have, suppose, invested in 2005 or 2006, and that to a lot of money. Promoters are doing it. Promoters are doing interstate transfer because, you know,
your cutoff date is anyway Jan 31st.
Yeah, but you know, you don't want to see, in a lot of cases, people would not just want to, in the first year, deal with the tax authority. You know, just take money home. And then after that, you know, come up fresh in April.
Raise your base to 31st of March.
I would, you know, actually, you know, I would completely, totally and 100% ignore the March number. I would say that, in fact, April number, and this is just a hunch, April number would not only be higher than, say, February, it will compensate for March, because the redemptions, the same redemptions which took place in March, would be back in April. That's my hunch. And let's see, you know, you know, if FIRs are selling, if you know, the big guys are selling, then domestic. Why should we blame a domestic retail investor for redemptions in the month of March?
I'm not blaming, but I till the April, till I see the April number, I won't be worried.
April.
How about blaming anyone?
You know, there's just one caveat in April that I'd like to put out, because I was talking to a lot of people to make sense of this data. Now, what has happened in balanced funds, where a lot of money came in over the last couple of years, everybody obviously is being told to move from the dividend option to the growth option. So balanced funds actually gave a lot of dividend in March. Come 1st April, they'll you know, have to pay tax. So therefore, a lot of people are expected to switch. And when you switch, it's a redemption. So therefore, there's some volatility also in that category in April as well.
And inflows are intact, right? The gross inflows are intact. It's the redemption which has picked up. Lata, you said you would want to see the April number. I have no doubt in my mind that April would be on par with February, perhaps even higher.
Okay. All right, we will get to that in a bit. We will have a lot of mutual fund guys joining us to discuss these numbers. For the moment, money market views. Praveen Brahmbhatt of Veracity says the weak US economic data announced last week will help the rupee to trade with a positive bias. He says the rupee may appreciate to 64.50 levels, expects the USD INR pair to trade in a range of 64.50, 65 for the day. But I'll just concentrate on the bond call. Ajay Manglunia of Edelweiss says the weaker than expected US jobs data resulted in a sharp easing of US Treasury yields, and this will add to the positive sentiment in the domestic bond markets. However, momentum for further gains will be tempered given the size of the recent rally and the pressure of paper supply due to heavier than usual Q1 state bond issuance calendar. Ajay believes that the 10-year benchmark bond yield is likely to trade in a range of 7.12, 7.18 today. Yeah, that state issuance is going to be a negative. It was heavier than usual, and the FPI limit for state is not increased.
Okay, well, the US market had a big downtake on Friday. Here's Manglam with a world view.
Well, two different sets of pictures as far as the US markets on Friday and what seems to be today is concerned, because if you take a look at Friday, there was a sharp downtake close to 600 points on the Dow, Nasdaq and S&P losing about 2% as well because trade war fears did resurface. But over the weekend, we saw some change in the tenor and tone of Donald Trump's tweet. For instance, on April 7, when he said that US hasn't had a trade surplus with China in the last 40 years, and this cannot continue given the fact that they're losing $500 billion every year. That changed into President Xi and I have always been good friends in a tweet late last evening where he said China will take down its trade barriers because it's the right thing to do. So basically, he just showed an olive branch, and that caused the US futures markets to improve, and that indicates that we may see a gain of almost 100 points at the start of Dow today. So the stocks that lost in Friday's trading sessions, the likes of Boeing and Caterpillar, which were down about 3%, likely to lead the markets higher today. But the problem point has been the new consumer technology companies, Amazon, Apple, as well as Netflix, all of them losing anywhere between 2 to 3% on Friday's trading session. All of last week, the Dow gave up about 0.7%, 2% cuts on the Nasdaq because of the cuts that we saw in the aforementioned stocks. A weaker than expected jobs data, that one was also a bit of a concern. 1 lakh versus 1.95 lakh added. Weakness across the European markets. Emerging markets saw some weakness too. But because the US futures are higher, the Asian markets are higher, the SGX Nifty indicates a cut of 0.3%. Let's see where it goes. All
right. Thank you very much for that summary, Mangalam. We have an expert to join and put more spin on what's happening globally. Paul Kitney, the chief equity strategist at Daiwa Capital Markets, has joined us on the phone line. Good morning, Paul, and thank you very much indeed for joining us. Well, I won't start with the usual trade war question that we ask all our experts, especially on a Monday morning. Any worries at all about this 103,000 jobs created, almost half of what markets were expecting?
Yeah, so I don't think that this is a terribly big surprise. It's a fairly volatile series. I think we need to sort of take a step back and look at, the trend, and the trend over the course of the last 3 to 6 months has been quite positive. So I think the labour market still is showing signs of tightening. It's still consistent with this gradual policy normalisation on the part of the Fed, and I think that continues throughout the rest of this year.
Okay, so you think that this is one-off and we should be back to the 200,000 average in the months to come?
Absolutely.
Okay, so in that case, let me now move to the trade war issue, war or no war. But Paul, what is the sense? I mean, what's the trajectory forward for the US equity market? Is the trade talk continuing to sort of weigh on sentiment?
I think so. I think again, we need to look at the trade talk in the context of a negotiation process. So, we saw sort of, the initial volley of $50 billion in tariffs imposed on China, the initial muted response of $3 billion announced, and then, we saw sort of the upping of the ante with an additional $50 billion on the part of China, and then the US is talking about $100 billion. So this, I think, we need to step back and realize that none of these tariffs have been introduced as yet, that this is got to be looked at in the context of a broader negotiation discussion between the United States and China. Now, the markets initially sort of, have been risk-off as a result of this. But frankly speaking, I think until we see this negotiation take place, until talks take place, it's going to be very difficult to ascertain the genuine effect. My view is that this is actually likely to be a storm in a teacup, and this correction that we're seeing is going to be an opportunity.
Okay. Well, Paul, in that case, a final question. The global markets, I mean, if you take the US markets as the benchmark, have been getting one bad news or the other. Either it's a tweet or an actual increase in tariffs, or it is Facebook and the problems it faces, or a warning against Amazon, or maybe more lately a one-off jobs data. But it seems to find resistance regularly at higher levels.
Yes, I think that's true in terms of the very, very near term.
Okay.
So the way in which I'm looking at this, I think we sort of need to look at the context of all of this. So we're hearing some data. We see a slightly lower than expected jobs data point. We must remember actually at the end of January, beginning of February, people were concerned about inflation.
Okay.
And we're concerned about inflation overheating.
Right.
That's gone now. So, I think that the real sort of true context here is that the U.S. economic expansion is still moving along quite nicely.
Okay.
It's not overheating, and we're in reflation, not inflation nor deflation.
Okay.
This is actually constructive for equities.
All right, point taken. Thank you very much, Paul Kidney, for joining us and putting that into perspective. Well, you can't worry about both. You can't worry about an inflation driven by growth and about poor jobs data. So probably we have a good thing going in the US.
It seems like it. As he also mentioned, that it's more like a storm in a teacup than anything else, all the trade war talk. Let's move on now. The government is very comfortable with the RBI's policies and its stance. That is the word coming in from the Economic Affairs Secretary after the Reserve Bank of India announced its status quo policy. Speaking at the India Business Leader Awards, he also said that bond yields could see a further reduction.
I don't think this is a dovish policy. It is a realistic policy.
It's a realistic policy. It's not a dovish policy.
And very realistic assessment of the inflation situation. Very realistic assessment of the growth position. And therefore, what RBI has put out is something which we are very, very comfortable with. You refer to the bond program. What we decided for the 6 months is actually not cutting short the program. We are evenly spreading the program in both the halves. So when we sometimes see that 48% of the borrowing program is what has been announced, if we take out the 25,000 crores by which we have actually reduced the program, what we have announced is about 50% of the total. So there is no backloading, there is no front loading. It's a very balanced, equally paced kind of program. And you saw the effect of that. And we have also aligned our issuances to the market demand. So we have spread the bonds across the different maturity spectrum, so that the issuance is meeting the demand as well as an even paced out, but overall reduced program. And also this inflation outlook which has been put out, growth good. I think we should have a reasonably priced, which is what is already you see.
Yes.
And maybe there is some further reduction in the bond.
The SGX Nifty is cutting some of those losses, still in negative territory, but now we are looking at a decline of about 30 odd points compared to 44 when we began the show. Some of the other Asian markets are actually holding out in positive territory. Well, it's time to get stock specific. Our entire team is standing by with the list of the top 10 stocks to watch out for today. Good morning, guys, and happy Monday to all of you. Anuj, let me start with you, as always. What's on your radar?
So, ICICI Bank, Surabhi spoke about it in first segment as well. It's a stock. If you see a longer-term chart of the stock, it's made a classical double bottom. 260 is the level. That's, of course, 1 month. But if you see 6 months or 12 months, you will see that, there you can see once in November 17 and now in April 18. Somewhere around the 260 mark is where it's made a bit of a double bottom. It's seen very strong delivery buying. And stocks where you throw a lot of bad news and they rally normally show strength. And valuation-wise, it's trading at its historic low in terms of valuation. So, again, I could be wrong, but I'm just reading what the market is telling me, that perhaps the stock is building in something that maybe all the negatives are now priced in. The other one, really, NBFCs, and within that, the CV, Shriram Transport. You've seen how Ashok Leyland and Shriram Transport basically, move together. And this one also is now trading at lifetime high. Strongest NBFC stock has seen big delivery-based buying. So that is one space which has done remarkably well over the last few months.
We'll have reason to cover both that again. And I think Ritu Singh is going to tell you what might keep ICICI and all other corporate lenders a bit happy. Ritu?
Well, that's right. There is some breather coming in for banks. If what we are given to understand is that both the government and the banks have made their representations to the RBI on the Feb 12 NPA resolution circular, and some tweaks are coming very soon. The parliamentary committee is also set to meet the bankers tomorrow on this particular issue, so do expect some changes to come in. There are several proposals made by the industry, by the power secretary to the ministry, from the government as well as from the bankers' side to the RBI. But the key changes that are expected is, one, is the doing away with the one-day default identification or reporting and allowing a 30-day cure period instead. And two, the reduction in the lender's approval for approval of resolution plans from 100% currently to 75%. Several other proposals have been made by bankers. Now, some of them could or could not be accepted by the RBI. Those include, allowing restructured cases to remain in a standstill mode until the end of the period or August 31st, whichever is earlier. Crucially, also refinancing of standard loans to infra will not be qualified as restructuring. In fact, we also had a chance to speak with some members from the finance ministry, specifically Mr. Rajiv Kumar also, in a conversation with Shireen Bhan, did allude to this fact. Listen into that conversation.
IBA has represented to the RBI. There are representations which have come from other sources as well. The regulator is seized with the matter. There are 2-3 specific issues out there. One is about the one-day default. Another is about the veto. So I'm sure the decision will be taken and the references have been sent to the regulator for this.
Okay, so hope springs eternal. I personally want to throw my weight in favor of the rules that RBI has put in, because it's about time we flushed out NPAs and started on a clean slate. Just kicking the can down is not making any sense. But nevertheless, for the markets, immediate relief will mean lower provisioning. So that becomes very important. And add to it what we got from the Reserve Bank on Friday, that foreigners can buy 59,000 crore more of government securities. This could mean that yields are continuing to go towards 7.1 rather than the 7.7 that we saw in Jan and Feb. And that will mean good news for PSU banks, because mark-to-market investments will see a write-in of profit, as well, of course, NBFCs who can borrow more cheaply. So keep both those on your radar. Some of them, of course, Anuj pointed out.
Oh, well, absolutely. Lots of positives, as we've been saying, coming through for the bond markets of late. Well, let's now move on. Titan in focus as well this morning. Manglam, what's the quarterly update like?
The quarterly update is good. You guys are talking about good news coming in for the NBFCs. Good news coming from the jewelry sector as well, because the quarterly update that Titan said, they said that the jewelry sector, the jewelry retail sector, that one grew mid-teens. Last quarter, it was an 8% growth, and this time it grew mid-teens. And what was a big positive is this was despite no significant new collection launch. So the old collections itself, they're showing mid-teens growth, and that means augurs well for the company's full-year growth as well. Watches, they too had a great quarter. This one because of e-commerce and the multi-brand outlets that they've started tying up with. They promised a plethora of new tech-enabled products in FY19, so watches look good too. What doesn't look good are the sunglasses ahead of summer, so just keep an eye out on that. But jewelry, watches doing well, should augur well for the stock, given the weakness that we saw in all of last week.
All right, thanks for that. Let's get to Nigel now. Nigel, you have a bunch of stocks, steel prices, announcements from NMDC.
That's right, Lata. In the last quarter, steel prices were hiked by around 3 to around 4,000 rupees on a per ton basis. Now, in the month of April, the prices have been hiked by around 500 to around 1,000 rupees. So in comparison to the last quarter's price hike, this is small. But what's important is that now input costs, they've started dipping in lower, and that's why brokerages are quite positive. They're saying that the June quarter EBITDA per ton as well will look quite good. So watch out for steel stocks today. They could do well. Secondly, watch out for NMDC. Remember, we had the management on our channel numerous times. They said this time they'll do around 36 million tons, and they've done that number. So it's a bit of a growth that we saw on a year-on-year basis. FY19, they've guided for 38 to 39 million tons. We'll have to watch out for that. And finally, Goa Carbon, another small stock. The production numbers were released. The sales volumes, in fact, are up by nearly around 16%. So watch out for that stock as well. All these stocks should trade in the green.
Okay, thanks for that. Ekta, now to you, Max India.
Well, reports are indicating this morning, Lata, that Max India is in talks to buy 47.5% stake in Max Healthcare, which is basically the hospital company that the company owns. This is from their South African partner, Life Healthcare Group, for a valuation of around 450 to 450 million odd dollars. And that will result in them becoming majority holders in the particular company, Max Healthcare, and hence maybe the stock could be in the green, despite the fact that there is one of the stakeholders selling. It is a promoter that is infusing funds into it.
Okay, all right, Ekta, thanks for Max India. But a couple of pharma stocks also in the news today?
Well, yes, there is a Credit Suisse report, and I expect Cipla, Sun, and Oro and Torrent to probably be in the green on account of it. CS has highlighted that the increasing trend of ANDA filings or new drug filings in the US is worrying. The trend really goes against the generic company's commentary that margins in the US have already come down, and they expect price erosion to accelerate from here rather than decelerate. They prefer Cipla, Sun, Aurobindo, Torrent amongst the others.
Okay, thanks for that. Sonia, MRPL. Sorry, Sonal, I'm sorry, Sonia out of habit. Sonal, Mangalore Refineries.
Yeah, this stock will be in focus today because there's a board meeting on 10th of April where the company will be deciding to up the public shareholding by 25%. Currently, the public shareholding stands at around 11.42%, and the promoter shareholding is at around 88.58%, which includes ONGC holding around 71% and HPCL holding around 17%. So these two stocks will be in focus as well, along with MRPL.
Okay, and what about Tata Chemicals?
Well, Tata Chemicals has made an acquisition of around 123 crores where they'll be buying Allied Silica. And this is in tandem with their plans of investing around 295 crores to buy enter highly disposable silica business. Now, HDS, that is highly disposable silica business, has a market of around 5,000 crores. And Motilal is quite bullish on this business. It says that the company, if it enters into this business, will be able to gain market share of around 12% and will be able to do revenues of around 450 crores with 23% margins. So right now, they've only acquired a part of it. If they do more of it, they'll be able to add more to their revenues.
Okay, all right. Thanks, Sonal, for that. And we're not done yet. Anisha is joining in with all the other stocks and news this morning. Anisha.
Well, thank you, Surbhi, for that. Yes, I'm the harbinger of good news today because all of my stocks are expected to stay in the green. First up, PTC India, wherein the company has signed a contract to sell the 100% power generated by Himachal Baspa. That can be close to 1,000 megawatt. So that should hold up in the green. Moving on to NLC India, the company has been telling us that they're looking to expand the power capacity. Now, we understand 1,000 megawatt would be expanded by July 2018 itself. And by end of the year, which is March 19, they're expecting the total capacity to be around 6,200 megawatt. Moving on to Apollo Pipes, where the company has commercialized or started commercial production at one of its units in Ahmedabad. Vishaka Industries, they are expecting that the production in the new unit will be starting from May this year. So that is the Telangana unit I'm talking about. And lastly, for Indiabulls Real Estate, well, the company has bought a new commercial property in Gurugram, and that's the reason they expect the annuity revenue on an annual basis to be around 1,547 crores versus the 1,450 crore guidance that they had given. So that should also hold up in the green. Back to you.
Okay. All right, Anisha. Thank you very much for that. So on that note, let's quickly recap our list of top 10 stocks for the morning. Now, stocks from the list which are expected to gain are as follows. So Nifty Bank, the PSU Bank Index, HDFC, Bajaj Finance, Indiabulls Housing, L&T Finance, M&M Finance, ICICI Bank, Shriram Transport Finance. Those are a whole host of NBFCs for you. Titan because of the quarterly update, then JSW Steel, SAIL, NMDC, Goa Carbon, largely all positive. Max India, MRPL, Cipla, Sun Pharma, and Oro. Torrent Pharma as well because of the CS note. Tata Chemicals, a small acquisition coming in over there. And the next on the list is Dilip Buildcon, PTC India, NLC, Apollo Pipes, Vishaka Industries, and India bulls real estate. So it's a long list of almost all green stocks this morning.
Feeling that the research team is now biased in favor of the bulls. But yeah, I think there's some important views that you would like to hear. Ritu Singh at the India Business Leader Awards caught up with Shankar Sharma. And here's what his take is on the markets, especially the banking sector woes.
Insolvency cases, that's a big theme playing out in the banking sector. Now, some of the large cases are getting resolved, but do you think for the equity shareholders, is this a good thing that what we're seeing playing out? There are good bids that are coming in. Some of the haircuts are very low for the large operating steel plants. Should equity investors in these companies be excited?
No, look, in any bankruptcy or a near bankruptcy situation, there's nothing in it for equity shareholders. I mean, that's the law of the jungle. So you're not going to get anything. I mean, you're lucky if you get 5 cents to the dollar, if at all anything. Because if I'm the buyer of a stressed asset, I'm going to say I'm going to pay the equity holders who have no claim, who are last in the chain, in the food chain, I'm going to give you nothing. And what choice, does the court have or the lenders have? They'll agree to my demand. So they will get 4%, 5%, 1%, 2%.
But do you really think it's the best idea for resolutions for the banking sector right now? We're seeing a lot of litigation cases coming up. I mean, every buyer wants to outdo the other. We've seen what's happening in Binani Cements. Are we in for more troubled times after throwing away SDR, S4A? I mean, is this another problem?
I think this is a good thing. I do not subscribe that that it's not a good thing. I think it's a good thing. I think it's very early days for the regulation. I think we have to give it a bit of time for it to kind of stabilize and find its own feet. But I think where the problems lie are this whole concept of disqualifying people from bidding. So, you have, either the promoters who are not willful defaulters, they are barred from bidding, which I think is an absurdity, number one. Number two, on the other hand, you have, even if you held a small stake in a company which is a non-performing company, you're barred. I mean, that's ridiculous. I mean, which you had the ArcelorMittal situation, and there can be many others. Or if you had a penalty imposed by somebody 10 years back, again, you can be barred from bidding. I mean, all these things need to be just, forgotten about. Here, you have a limited point. You have to sell this thing, get the money. And the government should not, or the regulations should not lose sight of what you are in it for, which is to get money back for the lenders, long and short. That's it.
Talking about banking, we know the problems of the public sector banks, but do you think private sector banks, with what we're seeing playing out right now, are really the best bet in banking sector?
Well, I am not a big fan of banking in any case. I mean, I don't like banks, broadly speaking.
But what do you think will come out of what we're seeing, the current mess that the banking system is in? What do you think? How will we come out stronger?
I don't know whether we'll come out stronger, weaker. I mean, all I do know is that I think we are kind of exaggerating in our own minds the importance of this. It is important, but remember, banks cause problems everywhere in the world.
I see.
They are the root cause of all crises in macroeconomics or in stock markets.